Hello and welcome to this session. Audit is about report writing, right? In accounting, when we have created the numbers, we want to always report it. Same thing with audit. When auditors go to the field and they've done their work, they end up reporting. So this session, we're looking at reporting. And we're going to look at 4 different items under reporting. So the first item, we'll be looking at subsequent events and going concern. Then we'll look at management representations, and then we'll look at final stages of the audit, and then the report to the shareholders. So auditors in their reporting, they can report to management. That's what we normally would term the management letters. But here we're looking at more of reporting to those who have contracted them, okay, the shareholders. So reporting to shareholders. But we start with the going concern, subsequent events and going concern, right? I'm going to share the screen. Then we'll look at the learning objectives, and then we proceed from there. I will make sure it is quite straightforward without any technical jargons. All right. Definitely, hopefully, you would have seen this screen. So I'm going to fix that. Subsequent events and going concern. So what do we mean by subsequent events review? Like the name sounds, there are some activities that happen after the year end of the company's financial reporting cycle. So these are subsequent events. We must review them. The reality is that some of them might require us to adjust the account. Some will require that we don't adjust the account. Now, we need to understand the kind of audit we need to undertake as auditors in respect of these subsequent events and going concern. Now, with the directors of the company who are responsible for preparing the accounts, what is their role in relation to subsequent events and going concern? And what will be the implication on the auditor's report? Then we want to also look at any particular issues with smaller entities, all right? So ISA 560 covers subsequent events. And like I said, these normally occur between the year end of the company's annual report and the date when the accounts are finally signed and published. Anything can happen in between those times. And there are times that, be careful, company directors might be smart enough. If they have an event, an activity which could affect their reports, and it happened towards the year end, they can delay it and post it in the next year. But check, when did the transaction take place? Okay, so like I said, 2 things will happen. One requires adjusting. So there are events which provide additional evidence of something which existed at the balance sheet date. And then the non-adjusting, they may be material, yes, but they did not occur within the balance sheet date. They occurred after. In such situations, do we let it pass? No, we disclose it. We disclose such events, okay? So like I said, 560, ISA 560, we're looking at specific inquiries which deals with whether new commitments or borrowings or guarantees have been entered into by the bank. There could also be some sales and acquisitions of assets which have occurred or may have been planned. Now, also check whether there have been any increases in the capital, the share capital, whether they've issued any debt instruments. Also consider, so could be new shares or debentures, an agreement to merge or liquidate, whether these have been made or has been planned. Also, whether any assets have been appropriated by the government or destroyed by fire, by flood, any natural disasters which may have occurred. Whether there have been any development regarding contingency. So you may be more critical looking at IAS 37. Okay, could be contingent asset, contingent liabilities. And then whether any unusual accounting adjustment have been made or being contemplated to be made. Again, check whether any events have occurred or they are likely to occur, which will question whether the company's policies they've used in preparing the financial statement is appropriate or not. So check those events. And if they call into question the validity of the going concern assumption, we may adopt some policies or some activities which may question our policies, and we may be thinking we could survive as a company into the nearest future, but into the foreseeable future. But for all you know, this activity could question the underlying principle of whether this company would really survive. Now also check whether any events have occurred that are relevant to the measurement of estimates and provisions made in the financial statement. So IAS 8 comes in handy. And again, IAS 37 provisions also comes in handy. Make sure the criteria have been met, okay, for provisions and for financial estimates as well. Now, whether any events have occurred that are relevant to the recoverability of any asset. Now, which events are normally adjusting, requires to adjust? Allowances for obsolete inventory or bad debts, obsolescence, will require us to adjust. Amounts receivable under insurance claims under discussion, and the balance sheet, and all that we are seeing under adjusting events deals with those which occurred within or before the balance sheet date, the year end of the financial statement, okay, or the financial period of the company. Settlement of legal case, it occurred within the operating period, but this would have to be settled after the balance sheet date. The date of occurrence is what we need. It's quite important. Some events take place after the balance sheet date, but they are shown in the account. Dividend payments, tax adjustment, check those ones and adjust them. The non-adjusting events normally occurring after the balance sheet date, so issuance of share capital, major construction of groups and companies, significant acquisitions, changing the way the company operates, losing some assets due to flood, fire, natural disasters, any strike actions, legal prohibitions, those ones will normally require some disclosures, but not adjusting. Now, the audit procedures, read the minutes of the directors of the meetings, and then you'll find out whether these things occurred. Normally, since they are material, they will normally be discussed at some level of the board meetings, okay? Not only the meetings of the board, but any other committees, which are very essential to the run of the business. Review or management procedures for identify subsequent events. They should have some procedure. Inquire of management if any of such events occurred, and that's what we will normally see under the word management representation. Review budgets and forecasts. Review year-end balances using the normal audit work. For example, if you want to see the bank balance, talk to the bankers of the company, get independent confirmation from the bank to verify or to authenticate the year-end balances of the company in terms of their cash and bank balances. And like I said, written representations from management is important. After this session, we'll be looking at written representations. Now, events after the auditor's report. What if we have issued our report? Now, if adjusting events arise after we have signed the audit report, what do we do? And either before or after the accounts are issued, what do we do? Review the event and gather evidence about it. So what we're saying is that it's not totally cast in stone that once we've signed a report or we've finished our work, we can't do anything about our report. We can do something about it. That's why we say audit planning is always an ongoing process. It doesn't end. Now ask management how they intend to deal with this issue. And if it is necessary, you have to reissue the account with a new report. You change the old report that you have, okay? And you provide a new auditor's report with 2 dates. One, the original one, and then the second with amended date. And if the accounts are not amended or reissued, seek legal action, report it at the AGM. Now, auditors can also take steps to avoid reliance on the auditor's reports on set of accounts which proves to be incorrect. So if I have issued a report and later I realize that the subsequent events would cause somebody relies on my report. Subsequent events they don't come to my attention. Later I found out. And then the person, you remember the principle of proximity. And then the user of the account would rely on this particular statement to make an informed decision. Auditor's liability are there, remember. So what you have to do is that take steps to ensure that people will not rely on that incorrect report which you issued. Or the report is already out. Somebody is using it for investment decisions. Now, subsequent events review would include consideration of what current and unexpected profitability, debt repayment, sources of funding continuing. Okay. Also note that it is for the directors to confirm whether the company is solvent will survive as a going concern, and they must provide this evidence for the auditors to review. Now, if the review by the auditors indicates solvency or other going concern issues, then we need to clearly indicate this as auditors in our report. Going concern, 570, ISA 570. The auditor's responsibility, we want sufficient, appropriate audit evidence to conclude that something material may have occurred which could affect the going concern prospects of the company. Or whether the company, the management prepares the account, whether the management use of a going concern basis for accounting is correct. Or do they have to use a breakup basis because they wouldn't survive? Now, these responsibilities will exist even if the financial reporting framework used in the preparation of the financial reports of the company does not include an explicit requirement for management to make specific assessment of the entity's ability to continue as a going concern. Whether they think it will go, the company will survive as a going concern or not, we have that responsibility to check. Management has the responsibility to provide us the basis, and we must check. Now, ISA 570 states that management has the responsibility of deciding whether the company is a going concern, and usually we look at a minimum of 12 months, not a maximum, okay, minimum, that at least in the next 12 months it will survive. Now here, as auditors, we should review the financial statements in the light of events which are arising from the audit, and in the period between the year end and the date we sign the audit reports, to check those things, and it could question the going concern status of the company. Now, these are assumptions underlying going concern that management will be able to influence the way the business is run. Products and services of the company will continue to be bought by customers. Suppliers will continue to trade with us. They will give us supplies maybe on credit, continue to give us the supplies that we need. And then the company will have a cash to fund its operations. Now, financial statement must be prepared on a going concern basis, unless we think that this company will not survive. In that case, we prepare it on a breakup basis. So, for going concern, subsequent event review should also include consideration of, like we said, I think we've highlighted this current and expected profitability, debt repayments, and sources of funding. Now, issue: is there any uncertainty over future events? What about the size and complexity of the business? What does it tell us? The nature of the business, will it be affected by any external factors? Will subsequent events render invalid decisions made at the time based on the information available at the time? If these occur, then you must raise the flag. You must report this in the audit report, okay? Now, these are indicators of going concern. Excess liability over assets, not too good for us as a company. Borrowing facilities, not a great. People don't want to give us extra loans. We have breached the loan covenants we contracted with our bankers. We have issues with cash flow, maybe running on overdrafts. We are selling fixed assets, and we are not replacing these fixed assets. Denial of trade credit. Suppliers are not ready to give us supplies on credit. We have to always go to our debtors, our creditors, to restructure the loan. Oh, we're supposed to pay on every month. We just go and say, listen, we'll be paying you every 2 months rather. Or we have to go and reduce the tenure of the loan. Instead of paying it over 5 years, we have to now go and rearrange to pay it over 10 years. And then when the time is up for us to pay, we are not able to pay the dues, okay? There are also operational indicators, market changes in the market, technology, legislations affecting our company. We are losing key staff. We are depending on very few product lines in a depressed market. We are losing key customers to our competitors. Key suppliers, we are losing them. They are not trading with us again. Our products are going obsolete. We are losing our reputation. We are being taken to court here and there. There are other indicators like non-compliance with some capital or statutory requirements, especially with the financial services. You would have had liquidity coverage ratio, capital adequacy ratio, net stable funding ratio. These key statutory requirements, you are not meeting them. There are some pending legal and regulatory proceedings which are against the company. And if they are successful, the company will likely pay some significant claims. Changes in laws and regulations which may affect the company's operations. There are some catastrophes which may have happened and they have not been insured, or they have been underinsured. So the indemnity we will claim from the insurance company will be low or less than expected, or less than the value of the items we insured, okay? Now, the fact that one or more of these have arisen in the business does not conclude that clearly the company will survive, will have going concern issues. No, okay? But they are just indicators which you should consider as an auditor when you are making judgments. What is the audit objective here? The auditors must decide whether sufficient appropriate evidence has been gathered. We should support any disclosures we make in the financial statement with some sufficient information or evidence. We should also check whether or not a material uncertainty exists regarding the use of the term going concern basis. Now, the procedures we must carry out as auditors is that we should examine the information supplied by management. We should check it. It cannot simply be accepted at face value. If they tell us this per their representation, that's not sufficient. We need to check. An attitude of professional skepticism is also important in this review. To critically review and assess their cash flow forecast, read their minutes, confirm evidence of funding arrangements in place with lenders, of course, get the written representations from directors, but that's not conclusive evidence. Don't accept what they tell you as final. Okay. And when reviewing, you must consider whether senior management and particularly the board of directors, do they have the necessary skills and knowledge to understand what they are reporting, what they are preparing, to understand what is meant by going concern? Do they have it? What assumptions are they using? Are they reliable? You must also understand whether or not the management assessment has been made in accordance with applicable financial reporting framework, or they are using something based on their own understanding without any framework. You must also check whether they have the information needed to evaluate how the assessment was made, and how they prepared, and are they prepared to question or criticize the approach and contents of the assessment on the basis of the fact, not based on their feelings. So anything which is being provided by senior management should be supported. Okay. These guys who are giving these assumptions or the underlying information, are they involved in making the process? Are they involved in the entire process of making that statement that a company will survive as a going concern? Are they involved? If they are not, and so I prepare something and somebody comes to say something, explain it, it doesn't make sense. He who was involved in making the assessment must also be involved in providing explanation. Material uncertainty, if a going concern basis is appropriate, but there is material uncertainty, the question is, what should we do? Directors must describe this material uncertainty in the accounts. Auditors will provide a paragraph in the audit report explaining this material uncertainty. And if no note is included in the auditors, or the auditors disagree, then we modify the report. So directors give us a report why you think this is material, but you think uncertainty exists going in terms of the going concern. If you don't and we still disagree, we modify the report. But in any case, we have to always include it in our report. Now, if a going concern basis is not appropriate at all, then we issue an adverse opinion. We'll come to this audit report. But our adverse opinion simply is saying that we don't think the books reflect a true and fair view of the operations. That's it. Adverse, negative. Okay. It doesn't reflect a true and fair view. All right. The effect on the auditor's reports. If we agree with what we are saying, then we will say we have nothing to report in respect of the director's use of going concern basis. Right. If the nature of the uncertainty is fully and properly explained so that the auditor consider that the management have the necessary disclosures in place, then we'll simply include a separate paragraph where we'll head it as material uncertainty relating to going concern and explain it. Now, this should be highlighted in the note, in the financial statement. We should also give the reason for the uncertainty. Of course, they would have provided it to us and we will check it. And it also has to state that uncertainty exists, but the auditor's report has not been modified or qualified in this respect. Okay, so that is it for the. But when there's a disagreement, if we disagree with what they are stating, then clearly we will give an adverse opinion where we state that it does not show a true and fair view of the report. And we must explain the reason why we are giving this adverse report. And of course, we use that opportunity to explain the nature of the uncertainty to shareholders. But hardly, in rare cases, the auditors may refuse to express an opinion. It rarely occurs. Normally, agreement would occur, but who knows? Now, other standards, I'll just run through them quickly. So ISA 510, opening balances, 710, comparative information, subsequent reviews. Confirm amounts from previous years do not contain material misstatement. Check that balances carry forward from last year are brought down correctly. Check the corresponding amounts, they've been classified correctly, disclosed correctly. Accounting policies used are consistent. Auditor's report not modified. Okay, if so, has this been reviewed or resolved? Check your opening balances and comparatives, review them. Okay, look at the controls in place. Consult with management, client management, and consult with previous auditors if you are not the previous auditor or you are not the one who did last year's account. Obtain any working papers, all things given, all things considered. If evidence of the opening position is not satisfactory, then the final report must be modified. Comparative figures 710. So you're looking at comparative figures, okay, they must be based on consistent accounting policies, consistently presented, agreeing with previous periods, and disclosure notes in case of adjustments or restatements have also been provided, right? Okay, so this is where we end on the subsequent review and then subsequent review and going concern basis. All right. I will pause here or end this and then do the next one on the reporting. All right. Okay. See you soon.